You do not need a massive $5 or $10 million portfolio to retire early off dividends forever. And I'm going to show you why that's such a common misunderstanding. And the reason why I'm making this video is the other day someone emailed me asking the question, hey, how much do I need to save in order to retire early off dividends and make sure I never run out of money or have to go back to work? Now, over the last 2 decades, my firm has been helping people retire successfully, and we've set up a system to help people live off their portfolios, live off their dividends for essentially the rest of their lives. So in this video, we're going to go through a framework that we use with our clients to help you understand how to position yourself to live off your portfolio and your dividends forever. But first, we need to start with this one thing that a lot of people miss when it comes to dividend investing. And to understand this, we need to take a step back and look at a famous story of Warren Buffett, who famously bet $1 million that hedge funds would fail to outperform the passive S&P 500 index fund over a decade period starting in 2008. And it was really interesting because at the end of the decade, these hedge funds that use all these different advanced stock picking strategies and algorithms returned 22% on average, whereas the S&P 500 returned over 85%. But what does this have to do with dividend investing? Well, if we look at some longer term charts of the S&P 500, the data shows how dividends can be pretty useful and make up a significant portion of returns in the S&P 500. If we look at the growth of $100 over the past 40 years, dividend payers and dividend growers and initiators had the highest level of growth versus an equally weighted S&P 500 or even the non-dividend payers. So does this mean you should go all in on dividend investing? Well, not necessarily, because on the other hand, we also have to remember that by investing in only dividend stocks, you have missed out on all the great growth stocks like Apple, Netflix, Google, Meta, Nvidia, and those have done really well over the past 10 to 20 years. Now, you can debate the best strategy all day long, and you can slice time periods to look at past performance, but there is something where both dividend investors and growth investors can come together on. And by understanding this, you will put yourself in a much better position to retire early. And that's by understanding this philosophy. Individual stock picking, whether they are dividend stocks or growth stocks, is not a winning game for 90% of more people out there. And you can pick a high yield dividend stock that pays out a good chunk of income, but will you be in a position to live off that income forever? Well, let's look at an extreme example. If you look at AT&T stock, now it has a pretty impressive dividend yield. It's around 5.7%, which sounds great. But here is a problem with looking exclusively at dividend yield when it comes to the stock market. If we look historically, the value of $10,000 invested in AT&T over the past 24 years, your money would have actually tripled if you just held it in a simple S&P 500 index. And now this is the difference between earning 3% on your money versus 12% of a return over that period. So you would have lost to inflation. Now, so the first part of my framework for building a portfolio that will last forever is being diversified, because depending on one or a handful of dividend stocks can ruin your retirement. But we're not done quite yet. You can do all this and still be making a huge mistake. Now, I want you to imagine you built a diversified portfolio of funds and stocks that pay out dividends and everything looks great. But then something happens to your portfolio that we can all honestly expect if we decide to retire. And that is that we hit a recession. And can you still rely on dividends when you do hit a recession? So to understand this question, what I did was I looked at monthly dividends on the S&P 500 using historical data from Robert Shiller. And since 1950, the annual growth rate on dividends was 5.7% per year. And I was surprised because that's more than 2% higher than the 3.5% inflation rate over that time period. And most of the time, dividends are going up. In fact, dividends were positive on a year-over-year basis about 88% of the time since 1950. But just because dividends go up does not mean that dividend stocks are immune from bear markets, because those negative years could certainly throw a wrench into your retirement plan. Because during the global financial crisis, 57% of companies in the S&P 500 cut or eliminated dividends, and 22% did the same in 2020. Now, your income dropping by that amount can lead to a massive hole in your retirement spending because you still have those expenses. And at that point, you could create your own income stream by selling some stocks when dividend falls. But the problem with this strategy is that dividends tend to fall when the stock market falls. So you'd be selling shares while they're down, and that is just not an optimal way to create income. And I know there are dividend investors out there who buy blue chip companies with high or growing dividends to live off that income. That's a strategy that can work, but it's just not completely foolproof because many companies could get in trouble on occasion and they could be forced to cut dividends, capital allocation changes, all these different decisions. The stock market is volatile. This is where it makes sense to have some sort of liquidity buffer of cash, bonds, T-bills, CDs, money markets, etc., to break in case of an emergency. And there is one asset class that was positive during the great financial crisis, and that was treasury bonds. So by adding an extra layer of conservative investments, perhaps 4 to 5 years, depending on your risk tolerance, in that bucket as sort of an emergency fund, where you don't have to worry about your dividends dropping or your stock portfolio dropping because you have the income set aside in a separate bucket, and it won't derail your retirement plan because you don't have to sell stocks because of an ill-timed financial crisis. So finally, we know that we want to build a diversified portfolio. We want to have an emergency fund for those inevitable bear markets. But how do you calculate how much you need in a portfolio to retire off dividends forever? And unfortunately, like I talked about in the beginning, many people unknowingly fall into what I call the magic number trap. And it's because of misunderstanding how you should really be thinking about retirement income in the first place. So let's look at how easy it is to fall in this trap and then how to avoid it. So if you're relying on the math of just living on dividends, and let's just say hypothetically you need $100,000 in net income per year. I know that's a lot higher than the average of what people need, but just bear with me here. With a 2% dividend yield, that would mean you need a $5 million portfolio. Now, the S&P 500 has a dividend yield of less than that right now, but at about $100,000 divided by 2%, that's exactly what you need. A 3% dividend yield would assume that you need about $3.3 million. You can kind of see where I'm going with this. But let's look at something more realistic, something more diversified, because we understand that stock picking can have the potential to ruin your plan, and we don't want to just focus on a single stock dividend yield. And this is not an investment recommendation, but let's just assume you use the fund that targets those high dividend paying investments. Let's, for example, use ticker SCHD, for example. As of now, it has a dividend yield of about 3.89%. So at $100,000 of income needed, that's about $2.5 million needed in a portfolio to make this happen. Now, unfortunately, this is where many people stop and give up because they just don't have that much quite yet. They say, hey, it looks like I need to go back to work for another 5 to 10 years, but we need to go beyond the back of the napkin and look at some other levels that you can pull for your own retirement. So if you're living in the US and you have the funds to be able to even start thinking about an early retirement, I think it's safe to assume that at some point you will eventually have a Social Security benefit. Now, it might not be as much as you expect because you're retiring early. The math is a little bit different, but let's go a little bit deeper here. Let's assume that you're married and you'll have Social Security of around $40,000 per year combined, and that's being pretty conservative here. If we do some math, that would mean we no longer need a $2.5 million portfolio to generate $100,000 forever, because now we just have an income shortfall of $60,000 that we need to make up somewhere else. So now already just pulling this simple lever, you go from thinking you need a $2.5 million portfolio to realizing that realistically, at the time of your Social Security, you only need about $1.5 million saved. That's $1 million less saved because you just factor in one other income source. And then secondly, this one really does make a massive difference. It's taking a dynamic approach to creating income, an approach that allows you to sell from principal, live on dividends, and also be dynamic when markets go down. And the research shows that if you are willing to be dynamic in your approach to income, you can actually take higher withdrawals around 5% or more, which is actually more realistic than the overly conservative 4% rule. So at this point, if we do the math, you really only need around $1.2 million saved because you can safely take higher withdrawals. So if we need $60,000 and we're going to assume a more realistic withdrawal rate of 5%, you're already in a better position. Now, you may be saying, okay, but I have years until Social Security kicks in. That's where if you have a plan that can help you bridge that gap before Social Security, it can make a huge difference. A plan that will show you, yeah, maybe you need to potentially save more, or a plan that allows you to sell from principal and still be okay. Or perhaps you makes up that shortfall in the meantime by maybe even taking a part-time job, even if it's something that is way more enjoyable than your current job to make up that gap. But my main point is that your portfolio balance is not a magic number that you need to hit to generate dividends and live off forever. We know that dividends play a huge role in the performance of a lot of portfolios, but dividends are more of a tool in your early retirement toolkit to help better supplement your overall portfolio and overall income experience. Because if you have a complete plan that factors in all other sources of income, allows you to be dynamic when markets go down, having that emergency fund, and one that invests not just for dividends, but for total return, you can use your dividend portfolio as more of a tool to help you retire early rather than hit that magic number to live happily ever after. This is why my own personal approach, as well as the approach we take with our clients, start with how much you need to spend when you do retire, and then work your way backwards with more of a total return approach that isn't just focused on a specific size portfolio, but one that includes all the key ingredients and return streams to help you enjoy your money while your portfolio continues to compound as the stock market rises over the long term. Now, doing that exercise can help you understand on paper how much you might need to live off your portfolio today. But because we know that tax policies change, your spending will change, investment markets will change, inflation and interest will change. You want to be able to have a plan that is reliable when the stock market does go down and when these things do change. So you should definitely watch this video that will help you prepare for all those different scenarios. Once again, this is Matt Calcagno, a certified financial planner and advisor over here at One Degree Advisors. If you'd like to talk to me or someone on my team about your plan, feel free to reach out using the link in the description below, and I'll catch you guys on the next one.